Legal disclaimer. This video is for educational purposes only. It is not financial advice. I am not a financial advisor. Always do your own research and consider speaking with a qualified professional before making investment decisions. Top Dividend ETFs in Canada for passive income. Beginner guide. What if your investments could pay you cash every single month or quarter? Not from trading, not from guessing stocks, but simply from owning dividend ETFs. Today we'll break down how dividend ETFs work in Canada, how they generate passive income, and what beginners need to know before getting started. Simple, calm, no hype. What is a dividend ETF? Let's start from the beginning. An ETF is an exchange-traded fund. It's a basket of investments that trades on the stock market. Instead of buying one company, you buy many at once. A dividend ETF focuses on companies that pay dividends. A dividend is money a company shares with its shareholders, usually paid quarterly, sometimes monthly. When you own a dividend ETF, you receive your share of those dividends. That's where the passive income comes from. You don't have to manage each company. The ETF does that for you. How dividend ETFs generate passive income. Here's how it works. 1. The ETF holds dividend-paying companies. 2. Those companies pay dividends. 3. The ETF collects the dividends. 4. The ETF distributes them to investors. If you own 100 shares of the ETF, you receive your portion. You can take the cash or reinvest it to buy more shares. Over time, reinvesting can significantly increase your total return. This is called compounding, but remember, dividends are not guaranteed. Companies can reduce or eliminate them. Dividend ETFs inside a TFSA versus RRSP. Now let's talk about taxes at a high level. In Canada, most beginners invest inside either a TFSA or RRSP. Inside a TFSA. TFSA stands for Tax-Free Savings Account. If you hold Canadian dividend ETFs inside a TFSA, dividends are not taxed. Capital gains are not taxed. Withdrawals are tax-free. It's very simple and flexible. Many beginners like using a TFSA for dividend investing because income stays sheltered from tax. Inside an RRSP. RRSP stands for Registered Retirement Savings Plan. Inside an RRSP, dividends grow tax-deferred. You don't pay tax today. You pay tax later when withdrawing in retirement. An RRSP is generally focused on long-term retirement savings. Again, this is not advice. Just understanding how the accounts work at a high level, here are some popular Canadian dividend ETFs. Examples. Let's look at some widely known Canadian dividend ETFs. These are examples only, not recommendations. 1. Vanguard Canada, FTSE, Canadian High Dividend Yield Index, ETF, VDY. This ETF focuses on large Canadian companies with higher dividend yields. It includes banks, energy companies, telecom. It's concentrated in traditional dividend sectors. Yield is often higher than the broad market. 2. iShares Canada, Core MSCI, Canadian Quality Dividend Index, ETF, XDIV. This ETF focuses on quality dividend-paying companies. It screens for financial strength, stable earnings, consistent dividends, often slightly more selective. 3. BMO Global Asset Management, Canadian Dividend ETF XDIV. This ETF tracks Canadian dividend-paying companies selected for yield and growth potential. It blends income with some focus on dividend growth. 4. Horizons ETFs, Active Canadian Dividend ETF, HAL. This one is actively managed. That means managers select the stocks instead of following a strict index. Active management can mean higher fees, different strategy, potentially different results. Again, these are examples of popular dividend ETFs available in Canada. They all have different strategies, holdings, and fee structures. Always review the fund's objectives and risks before investing. Why diversification matters. One common mistake beginners make is focusing only on income. But income is just one piece. You want diversification. If your ETF holds mostly banks and energy companies, what happens if those sectors struggle? Diversification helps reduce risk. Some dividend ETFs are heavily concentrated in financials, energy, utilities. That's common in Canada. So it's important to understand what's inside the ETF, not just the yield. Yield versus safety. This is very important. A higher yield does not always mean better. Sometimes a very high yield can signal higher risk. If a company's stock price falls sharply, the yield may rise, but the dividend might not be sustainable. Chasing the highest yield can lead to dividend cuts, price drops, long-term underperformance. For beginners, consistency and sustainability often matter more than chasing the biggest number. Income consistency, another thing to understand. Dividend income is not fixed like a salary. It can fluctuate. Companies can increase dividends, maintain them, reduce them. During recessions, some companies cut dividends, so passive income from ETFs can go down during tough economic times. It's not guaranteed. That's why realistic expectations matter. Top common beginner mistakes. Let's quickly go over common mistakes. 1. Chasing high yields. Big yield numbers look attractive, but very high yields can be risky. Always understand why the yield is high. 2. Not diversifying. Putting all your money into one ETF or one sector increases risk. Even dividend investors should think long-term and broadly. 3. Ignoring fees. Every ETF has a management expense ratio. Higher fees reduce long-term returns. Even small differences matter over decades. 4. Expecting to quit your job quickly. Dividend investing is powerful, but it usually takes time, capital, patience. If you invest $10,000 with a 4% yield, that's about $400 per year before growth. That's helpful. But it's not life-changing overnight. Dividend investing is slow and steady, setting realistic expectations. Dividend ETFs can provide income, offer diversification, checkmark help with long-term compounding, but they are still stock market investments. Prices go up and down. Dividends can change. Long-term thinking is key. Most successful investors focus on consistency, discipline, time in the market, not quick results. In order to conclude, dividend ETFs can be a simple way for beginners in Canada to generate passive income. They're easy to buy, easy to understand, and accessible inside a TFSA or RRSP. But always focus on diversification, sustainability, fees, long-term strategy, not just yield. If you're just starting your investing journey, I've made beginner-friendly videos on how to start investing in Canada, TFSA versus RRSP explained, building a simple ETF portfolio. Check those out next to continue learning at your own pace. And remember, slow, steady, and consistent wins the race.